Hey guys, welcome back to the channel. So in this video, I'm going to cover the pros and cons of both LEAP options and owning shares outright. And so hopefully by the end of this video, it'll help you determine which of these financial instruments is best for you. Now, what are LEAPS? Well, LEAPS are long-term equity anticipation securities, and they're simply option contracts that have at least 1 year or more till expiration. So it's more for a longer term trade than it is of a short-term trade. And you can basically consider it an investment to an extent. Now, what are shares? Shares are the basic type of investment where it represents equity stock in a firm. It's ownership of a company, but these have no expiration. So you can own shares for an infinite amount of time. And the only way you lose your entire investment is if the company goes bankrupt. Now, with anything, there's pros and cons. And with LEAPS, the pros are it requires so much less capital, far less capital than owning the shares outright. And because of that, there's less dollar amount risk and there's a higher return percentage wise on your investment. But however, the cons is there is an expiration date, which means you can lose your entire investment by the expiration date. Whether it's 2-3 years from now, there's still that possibility that whatever contract you choose can expire worthless. Another con is if you're going to hold something for longer than a year, with stock, you get a dividend. With LEAP options, you don't, because technically you are not an owner of the company. So you will not get paid out dividends for holding the stock. And also there's a wide bid-ask spread. The liquidity is not there compared to shares when you're buying shares outright. Now, it depends on the company itself, but if you're buying something like Apple, Microsoft, it's the bid-ask spread is going to be very narrow, which is a good thing. But for some companies, the bid-ask spread is a lot wider when you're buying LEAP options compared to shares. Now, the pros to shares is, well, there's no expiration date. As I mentioned before, you can hold these for an infinite amount of time. You are technically part owner of a company, and the only way you lose your entire investment is if the company goes bankrupt. Another pro is, like I said, you will get paid dividends just for holding the stock. And so that could be on a monthly, quarterly basis, semi-annually. It just depends on how that company pays out its dividends, but you will be compensated just for being a shareholder. And like I said, the bid-ask spread for shares is the liquidity is a lot there. You know, it's easier to purchase, so that you don't have to worry about deltas and thetas and none of these Greeks, implied volatility, nothing. It's a straight up, you know, whatever your investment is, divide that by the share price, and that's how many shares you're able to buy. Now, the cons, of course, is with shares, it requires a lot more capital than when you're buying LEAP options, and because of that, you have a higher dollar amount risk. And you also get caught bag holding for some people. So instead of cutting your losses, because you know you have an infinite amount of time to recover your losses, people get called bag holding. And so while it's not a guarantee that that stock will recover, people feel more safe knowing that no matter how long it takes, that stock will recover eventually. But as I said, that's not always the case. And I'll show you an example of what happens when you bag hold and don't cut your losses. So no matter with what investment you choose, whether it's LEAP options or shares, there's always has to be risk management. Now, which is best for you? Well, that really just depends on your trading plan, your trading strategy, what your outlook is for that particular stock. You know, and again, risk management is a big thing. You know, so if you're looking at a company and you have a thesis that this stock is going to go up $50, you have to ask yourself, in what time frame? Are we talking a year from now, 2 years from now? And so all that plays a factor. Now, if you're looking to build a portfolio and just build it out over time for retirement, then your best bet is to just own shares of the company. And of course, the last thing, it comes down to capital. How much money do you have to invest? If you don't have much capital to invest, then obviously buying the LEAP options is the best bet, because you have that exposure to the stock and it can basically mimic the stock if you buy a deep in the money call, but with far less capital than owning the shares outright. But with that being said, let me take you to the Webull trading platform so I can compare the two and show you exactly what the difference is between buying LEAP contracts and just owning the shares outright. All right, guys, so we're here on the Webull trading platform, and so I'm going to use Walmart here as an example. So Walmart right now is currently trading at $149.53, and let's assume that you believe Walmart's a $200 stock, and it'll be a $200 stock by next year. You know, whether it's the summer or late next year, you just know that next year you believe it's going to be a $200 stock. Now you can decide, you know what, I'm going to buy 50 shares of Walmart. Well, let's just pull out the calculator here and just do a $149.53 times 50 shares. That's going to cost you roughly $7,500 to own 50 shares of Walmart. Okay. Now let's compare that to going out to January of 2023. That's 2 years. You know what? Let's go out 2 years and say you want to buy 50 shares. So that means you need a delta of basically around 50. That would cost you roughly $1,500 compared to the 75 that you'd have to put up if you were buying the shares. So that's a huge difference in capital that you have to put up front just to control basically the same amount to move $50 per dollar that this stock is moving. Now, of course, if you want to buy 100 shares of Walmart, well, it's going to cost you roughly $15,000. You can go up here and buy a LEAP options that's going to roughly mimic that, be $90, that it'll go up for every dollar move that Walmart goes up, you'll make $90, and that's going to cost you about $7,900. So again, you can see it's basically half of the capital that you have to put up if you're buying a LEAPS option versus buying the stock outright. But the advantage you have is if Walmart pays a dividend, you get the dividend. And the other thing is, when you're buying this LEAPS contract, most people are not going to buy 5 or 6 of them. If you have a small account, you're just going to buy one. So the thing is okay, now that I decided I want a LEAPS contract, when do I buy this? So again, that comes down to either fundamentals or technical analysis. The way I trade is I don't buy anything that's too extended from the 50-day moving average. So I would wait for a pullback. I did create a video on trading reversal patterns, which is, a pattern that I trade. That's how I take swing trades. I'll put the link in the description. And also, if you're not familiar with the terminology of options, I also made a video on that, and I'll put the link in the description for that video as well. But again, with shares though, most people can decide to either buy the 50 shares at this price or dollar cost average. So they'll decide, you know what, I'm going to put in $3,000 into Walmart, but I'll put in $1,000 at a time. So they'll put in 1,000 at this price, and if it drops, they'll put in 1,000 more. If it drops more, they'll put in the last 1,000. So they can dollar cost average. But again, with LEAPS contracts, you're buying one contract if you have a small account, and therefore your timing is, I guess you could say, it's crucial. So again, all that comes down to risk management. That's for another video, but I hope you get what I'm trying to say is that you have more flexibility when you're buying shares when you're entering the trade than just buying one contract. But again, the capital you're putting up is it's a substantial difference. Now let's look at Apple, for instance. Apple, the same thing. It's basically trading around the same price. But let's just say you think Apple's a $200 stock and you want to buy 50 or 100 shares. It's a give or take about 15,000. Now, if we go out to, let's just say January of next year, which would be 2022 or same year, 2023. Okay. You're looking at 50, say you want to buy, like I said, 50 shares. Well, you can come down here and $52, you're roughly paying about $1,800. $1,800, compared to $7,500 that you would have to pay for 50 shares, and $15,000 roughly for 100 shares. In this case, you would be paying anywhere about, if you want to get close to it, about $9,000, $9,500. So again, huge difference in the amount of capital you have to put up. And theta, of course, is time decay. That substantially decreases the further out you go. So that's always a plus as well. Again, like I said, guys, it really just depends on your strategy, what you're planning to do. If you're planning to build a portfolio for retirement, then shares is the way to go. If you're planning to just slowly build it, you just own the shares and you get the dividend if that company offers a dividend. But if you're more of trying to long-term swing trade, I guess, if you want to call it that, then buying the LEAPS options contract is the best bet because you're putting far less capital up front. And if you look at cheaper stocks, one stock I've been extremely bullish on, and I also have a video on that, is DraftKings. If you see DraftKings as a $50 stock, now this is more reasonable. If you want to buy 100 shares, it's going to cost you $5,000. But if you want to buy a LEAPS contract for January of 2023 with roughly 100 shares, you're basically paying about $3,400. So you're saving, $1,500, but $1,500 that you can save and put into another investment, that's something else you can do. So now if you just want to buy 50 shares again, you can come down here and buy one that's out of the money, and that's going to cost you basically $1,000, $1,000. So that if DraftKings were to file bankruptcy the next day, you would lose $1,000 as opposed to $5,000 if you were to buy 100 shares of it, and then there's nothing you could do about that. So as I said, guys, there are pros and cons to both. Depending on your situation, if your capital is limited, your best bet is to buy LEAPS contracts and, buy them 1 to 2 years out, especially if it's a company that is a high quality company that will continue to produce and continue to excel and grow. You got plenty of companies, Microsoft, Walmart, even Starbucks, all these companies, that have that trajectory of just going higher. You have a safe bet there. Nothing is guaranteed, of course, but again, the capital you're putting up front is substantially lower. But again, if you're trying to build a portfolio for retirement, then buying the shares outright is a great way to invest, and then slowly, like I said, dollar cost average until you basically have put in your entire capital you're willing to put into a company. And then in the long run, you're collecting dividends, and the performance of the stock obviously will dictate your return on investment as well. So hopefully this video answers some of the questions that y'all may have between the difference of the two, which one's better. And like I said, depending on your needs and exactly how you manage risk and what your outlook is for a particular stock is what will determine which is the best financial instrument for you. And there's no right or wrong. You can, use both. But again, that's up to you and your financial situation and how you plan to invest, whether in the short term or the long term. So with that being said, guys, if you have any comments, drop them down in the comments section. Don't forget to subscribe to the channel, hit that like button. I will catch you on the next one.